What's up, guys? Kevin here, and unfortunately, it's the time of year where my mortgage company sends me a letter telling me that my mortgage payment is changing. I've actually had a mortgage for the past 8 years, and every single year I get this letter telling me what my new mortgage payment is. And you can imagine this really threw me off because when you sign up for a mortgage, you assume you set up the terms, and for the next 15, 20, or 30 years, whatever it might be, that's what your mortgage payment's going to be, and you just make sure you keep paying that amount and everything should be fine. But that has not been the case for me. Literally, I've had multiple lenders, and every single lender does the same thing every year. And I realized this was just something that nobody seems to really talk about. So I wanted to kind of take down that curtain and explain to you guys what you can expect after your first year of having a mortgage, and basically year after year how things are going to go, so you can kind of plan your finances appropriately. So let's go ahead and talk about it. Also, if you want to see more videos like this, I regularly post videos about personal finance, getting out of debt, reviewing credit cards, and things like that. So if you guys are interested in that and more, definitely stick around and be sure to subscribe to this channel for more videos in the future. So in order to understand why my mortgage payment is changing, you have to understand what actually goes into a mortgage payment, because it's not just a payment for your house. There are a lot of different elements that build into the total amount that you're sending your mortgage company. Now, the first two is probably what most people are familiar with. It's your principal and your interest. The principal payment is what is actually paying down the value of your loan. So every month, that principal payment pays down the value, and that's actual value and equity you've built into your home. The interest is the extra fee that your lender is charging you. So they loaned you hundreds of thousands of dollars and you're paying, at the time when I got my mortgage, thankfully it was around 3% interest, but nowadays it's more like 6, 7 or more. So you're just paying that to the bank as, basically paying them for lending you that money. So it is very expensive over the course of a loan. It can be up to probably 50% of the total value. A lot of people are paying hundreds of thousands of dollars, almost doubling the value of their home and making monthly payments over 30 years. But that's just kind of how the lending industry goes nowadays. But besides that, there are other things that are built into your mortgage as well, because it goes into what they call an escrow account. And an escrow account is money that the bank saves on your behalf so that they can pay out for different things that they require when you have a loan. So for example, one of the things are property taxes, because when you live in a house, you have to pay property taxes every 6 to 12 months to the government to basically stay on the land that you just paid for. Now, we can argue about if that even makes sense in a future video. I have a lot of thoughts about that, but regardless, that's the current state of the economy. Now, if you don't pay your taxes, then you basically can lose your house, and all the value that's built into your house that you were paying the mortgage on is basically lost. So the mortgage company wants to make sure that they have that money to pay the taxes on your behalf, so there's no issues that could cause them to lose the home that essentially they own. Another thing is home insurance. Again, a mortgage company will require you to have home insurance because if the house were to catch on fire, or if there was a natural disaster, a hurricane, tornado, something like that, that would take out the house, home insurance would come behind in that situation to pay to rebuild the home. So this again just helps the mortgage company protect their investment and what they've loaned you money on. So if that were to happen, they don't completely lose everything that they've paid for, and they can make sure they're getting their money's worth. And then the last one is mortgage insurance. And this is one that is pretty common because if you don't have 20% of the value of your mortgage to pay as a down payment, you're most likely going to be put in a situation where you have to pay mortgage insurance. You can think of it kind of like if you have a car. If you pay $20,000 for a car and drive it off the lot, it's typically not worth $20,000 anymore. As soon as you start putting miles on it, the value begins to drop. So it's the same thing with a home. Living in a home, as things go on, the value can go down. Lately, yes, values have been going up, again, just due to the state of the economy, but that's not a guarantee. So if you pay $200,000 for a house and then you don't make any payments on the home, the mortgage company is going to take it back. But there's a chance that when they go to sell it to get their money back, it might only be worth $170,000. So the private mortgage insurance is what's going to make sure that they get the full value of the mortgage, regardless of what, the market is saying your house is worth. So all of these things are built into the escrow account to protect the mortgage company. So when they pay for your home, they make sure that they get their money back plus interest and everything that they feel that they're owed. So they'll put all of that money into a separate bank account that pays out as necessary. Now, usually they also add a little bit of a safety net there. So an extra $1,000 or a certain percentage of the estimated escrow of what you would need for the year. They'll add that onto there just in case prices change. But that's basically the set amount of what they need. Now, the letter that I got is the letter we get every year, and it is your escrow statement. So they're basically saying, this is how much money you were billed, this is how much money you were paid out, and this is what we estimate your escrow is going to be for the next year. Now, as you can expect, typically this goes up because as the value of your house goes up, your property taxes go up, your home insurance goes up, basically everything increases. So they basically look at the fees and they determine, hey, these prices are going up, so we estimate we need more money in your escrow, so your mortgage price is going to go up. Your monthly payment is going to go up to keep your escrow within that safe limit. So let's go ahead and read what we got this year. Due to your escrowed expenses like property taxes and insurance premiums decreasing, your monthly escrow payment will decrease to set amount. Additionally, your escrow account is projected to have a surplus. Because of this surplus, a refund check is being provided to you. Okay, this absolutely is not normal. This is not typically how this goes. I definitely can't complain, but there are a couple key things that I think I did to help it go in my way this year. So the first thing I did is I refinanced my house. And I actually did this a couple years ago while rates were still low, but the value of my house had gone up pretty significantly. And so what I was able to do was refinance my house and show that based on the new value of the home, I had more than 20% of that value in equity and less than 80% was left over on my mortgage. So because of that math, I was able to get out of my private mortgage insurance because more than 20% of the value of the home had been paid off. So that was a huge win for me. That took off a significant chunk out of the money. And I think that it's helping, my escrow be a little bit over what it should be. It's been over for a couple years, but this is the first time that I'm actually getting a refund check. And I think they just decided that it was too far over. And so they had to cut me a check to bring it down to where it should be. Another thing is every year when my home insurance comes back, usually my premiums go up. Again, as your home value goes up, typically that's the case. And usually I find that sticking with an insurance company doesn't help. They tell you that there are all these benefits with being a longtime member, but all they do is increase your insurance rates every year. So every year I shop around for insurance. And if my rates go up with the company that I'm with, I'll try to find another one that has a cheaper rate, and I switch every 1 or 2 years. So this year I did that as well. And even though last year my insurance rates were really high, I actually saved about $300 this year on my insurance premium. And I think that also is playing into the extra amount that was left over on my escrow and the lower calculation of what they're estimating my escrow should be for next year because my insurance premiums are significantly lower than what they were. Now, the only thing that I can't stop is property taxes, which did go up this year, but I guess with all the math and everything that they've done, they noted that I'm basically dropping my monthly payment by almost $100 and I'm getting a couple $100 back on this check. It's probably a good idea that I just save that check because I'm anticipating next year my premiums will go up again. And keep in mind still, this is elevated from what I was originally quoted when I refinanced a couple years ago. The price has been going up and up and up. And this is the first year in several years where it's gone down. But, it's a welcome adjustment. I'll take anything I can get. But yeah, again, I just wanted to make this video for anybody that's looking at buying a mortgage, or maybe you're coming up on your first year mortgage, or maybe you just got your escrow payment and you're thinking, what's going on? Am I getting scammed? Is this normal? Yes, this is how it goes. I've had 4 mortgage companies over the past couple years between different homes I've lived in and then the refinance I did a couple years ago. And it's just kind of a part of how it works. It's a good thing because it makes sure that they're not taking more money than they need. And this, again, is not a common case, but they do just want to make sure that they have adequate money so there's no shortfalls when they need to make a payment, and that would come back on you if they couldn't pay on your behalf. So something to think about, whatever you're signing up for. Maybe save an extra $100 or $200 a month just in case you need to pay that in the future. Just build that into your budget so you don't struggle with any changes. So yeah, I think that's all I have for today. Thank you guys for stopping by. Don't forget to like and subscribe, and I will see you on the next one.